So in segment 3, we're going to look at what is happening on the global front when we're talking about crude, what's happening with products, because there's a lot of moving pieces. And before we get into it, we'd like to remind you, please like, share, subscribe. Your support is appreciated. So when we look at global crude oil on the water, you can see that we're above the highs from 2020, from 2021. So we're still setting new seasonally adjusted highs. That's just the amount of crude. This is a mixture of what is in transit, what is in floating storage, and these are things that we think are going to continue. And just, again, bump above on that high end as we go through really the end of March. We don't see much of a shift in one way or the other in terms of where things are going. But on the positive side, Fortes just traded at a 2-year high. So the traded price was the highest since the end of 2019, according to Bloomberg, and it was about $1.70 above dated Brent. So again, there's still some positive movements when we're looking at crude differentials, which is what we continue to see as some of this tightening on the physical side. It's looking at it from the perspective of, where is it tightening? We're having some pieces tighten in Russia. We're seeing some of that in the West Africa as well, and now we have it in Europe. Now this is really driven based on the shortfalls that we're seeing in terms of what is going to come from the U.S. When you look at just the rally here, it doesn't make any sense to buy from the U.S. at this point. So you're going to see a slowdown into Asia, and they're trying to pick up what makes the most sense at this point. And that's where we're seeing a little bit more coming from Eastern Russia and a little bit more from West Africa into the Asian markets. It's still seasonally adjusted all-time high on the floating storage side, but it had a big drop because a lot of that has been sent into the market. So the hope is that you start to get a bit of a balance on the floating storage side, and then you'll start to see some of the production numbers creep back up. Because at this point, why am I going to produce and meet my OPEC target when I have all this floating storage? I'll just sell from floating storage, use cheap storage, which is leave it in the ground, and then as that clears, start to accelerate that production number and bring it back up to where you're really allowed to be based on what the OPEC agreement sets out. So now when we shift into in transit, you can see that a lot of these cargoes are getting to their locations, which is why we saw that shift up in floating storage. And it's really exactly what we described was going to happen last week and the week before, that a lot of these cargoes were purchased October, November, beginning of December. Then you had a big drop off in purchases. So it just transit time, you start to see them show up, and that's where we're starting to see this go from in transit back into floating storage, which you can see here, still above those highs. It's now above where we were, right at where we were in 2017. And we just think that it's going to remain at this elevated level as we go through the beginning of March. Now, on the positive front, when you look at India, so just looking at refined product demand in December, when you look at all oil products in the million tons came in at 201.26 million. That's 3.7% above 2020. It's still 7.2% below 2019, the last quote-unquote normal year. And the driver behind that remains diesel. So even though you're starting to see some of this ramp up, diesel remains that big overhang, which is, again, more of an industrial component. So as we're seeing inflation starting to take off, now Indian inflation did come in below expectations, but we think that there's going to be a fairly sizable acceleration in that front, which is going to, again, put pressure on where gasoline and diesel purchases are, especially on the industrial side. But gasoline so far has held in very strong, and we do think gasoline holds essentially flat to 2019. It's the diesel side that is going to remain under pressure. Now, when we look at crude oil export, U.S. crude exports and product exports, you can see that gasoline had a small bump of 56,000 barrels a day, 314,000 below the 5-year average. Distillate, an increase of 81,000, 358,000 below the 5-year average. Those are things that I think are going to remain a big overhang given where the market is in the U.S., especially distillate. Why am I exporting it when I can sell it here? But then when you look abroad, there's not a huge demand for gasoline given where Europe is, how they're putting more into the Atlantic Basin. and the amount of storage in the U.S. So this is where exports should be accelerating, but they're going to struggle to do that. So again, that we believe that'll be just below below the 5-year average. Propane had a makeup number, came in an increase of 616,000 barrels a day, taking us 440,000 above the 5-year average. It's going to be a bit lumpy. There was that recovery. And then crude oil exports had a big drop of 599,000 barrels a day, just below 2 million, coming in at 1.955. The problem is as WTI prices and LLS prices continue to shift up, this is going to reduce the amount people actually want to purchase and look to find other cheaper forms of crude. Even if it's at a higher differential, when you factor in the distance, the day rate, the insurance, it still makes sense to pay, which is why we're starting to see some of those increases in differentials, and this will leave more crude on the U.S. shore, which again will also result in those builds that we were talking about in segment 1. And this is again helping that when you look at just where the WTI Dubai spread is, it's moving back to about a $4 spread, which is really when you start to see an accelerating decline in the demand for U.S. crudes versus Middle Eastern and West African oils. So then when you look at the total U.S. finished gasoline exports, you can see that we're well below the 5-year average and well below that cloud. We think that you're going to see a little bit of an increase, but stay just at the very low end of that cloud, just given where the demand is in the open market. On the crude oil export side, you can see that we're below the 5-year average. We just think that we're going to essentially stay right around this level and bump along. It'll increase. It'll probably get closer to about 2.3 million, but still remain depressed. So then when we look at the amount of distillate, because one of the things that I had skipped over was the distillate front. When we look at what the amount that is happening on distillate, you can see that there was a fairly sizable drop. And we just think it's going to remain very far below where things are right now. It's going to be below the 5-year average and really set a new low when we're looking at what has happened so far. So here you can see that there's that low end, and we think it's going to continue to move down, stay outside that even the low end of the cloud, just because of the headwinds that we see coming. So then when we look at ethane exports, started off strong. This is really driven based on we have more export capacity, so we're starting off the year with more. So we expect to remain above that level. And then, as we said before, with the crude oil exports remaining at about 2.3 million. And then when we look at U.S. oil exports on the 4-week average, you can see they dropped to about 2.579 million on the 4-week. We think it'll bounce back up, but stay fairly close to the low end of what we were saying on that 2.6 million barrels a day level. And then propane, again, starting off the year strong and setting a new seasonally adjusted high. And that will remain strong, even though it'll drift closer within the cloud, but still stay at the high end. Now, when we look at what is happening in the loadings and export side, you can see that the Russian Federation, just how it's the nomenclature is sitting there at about 3.947 million. That's where it's going to be fixed in. That's where we should sit. Norway remaining fairly strong. Nigeria had that drop in February. Again, remember, trying to clear some of this floating storage, trying to clear some of the glut that they have, and that is resulting in that tightening of the differentials, which again is a net positive for them overall. Angola is something fairly stable. With Libya, there was a new facility that came on because of the deal that was struck yesterday. That will bring back some additional barrels. We think that it'll be just over 1 million, or about 960,000 barrels a day of export. So it'll be on the low end, but something that will continue to close the gap as long as some sort of peace can be maintained in the near term. Now, when we look at some of the differentials that we were talking about, Republic of Congo, February traded at 30 cents less than dated Brent, which is a gain of about $1. So a nice bounce there. Then when you look at Fortes, came in at $1.50 for January versus $1.15 on Monday. Brent at $1.50 for Jan into Feb, which was $1.15 previous. So you're starting to see some of these movements in general. Nigeria, as we said, traded at a premium of more than $2 a barrel versus dated Brent, a gain of 70 cents. And just following that, differentials have firmed thanks to the recent squeeze on supply from Libya, as we mentioned before, and CPC. Now, Iran set the official selling price of Iranian light crude at a premium of $2 a barrel. To the average Asian customer, that compares with a premium of $3.10 in January. So again, seeing some of that come down as well. Russian Sokol crude for March loading came in at a premium of $5.60, which is about $3 above where it had previously traded. And then Kuwait set the official selling price at $1.80 premium to Oman Dubai, and that compares to a premium of $2.80 from January. So we saw another drop. So you can see there's more competition coming. That's where we're seeing more movement from the Middle East, and that's going to keep some of that crude essentially locked in the U.S. So now when we start looking at lost supply, this gives you an idea of where Libyan oil production went and how it started off where it's going to kind of start off. So now we're going to get a little bit of reprieve. We're now back over 1 million, and we should be able to maintain exports of about 960,000. So Libya's oil production reached 1 million barrels a day after its biggest oil field resumed output after the militias forced a 3-week stoppage, and that's with the deal that was struck with the Petroleum Facilities Guard that we talked about in segment 1. So then when we look at crude, crude purchases by China, you can see China imports of Iran, Venezuela oil jumped to a 3-year high in 2021. Again, discounted crude, it makes sense to do it. So even though they're supporting Iran, they want the U.S. and Iran to make up. They really don't, because they like getting discounted oil. So as they've been buying more from Iran and Venezuela, they're buying less from West Africa. So this is that knock-on effect when you look at, well, why is Angola and Congo so weak? It's because they're buying more from Iran and Venezuela. And if we don't see that stopping, Venezuela just had an explosion, so that's going to crimp some of their exports in the near term. But Iran still keep maintaining flow, and that will continue to bleed into China. And so even though we've seen some things getting a bit better for Angola, Congo, that's going to be a bit of that overhang, is how much Iranian crude is going into China as China does reduce their purchases essentially through January and February. So then when we look at what happens in Genscape Europe, you can see that we're starting off the year at the low end, a continuation of last week. It's still above where we were last week, but just given the seasonality of it, it's at the lowest. So we're setting a new seasonally adjusted low. This will creep higher, but it's only by creep higher, it'll just fall within the base of the cloud, but nowhere near that 12-year, or I should say 10-year average. So now when we look at where the builds were, so you can see that there were builds pretty much across the board when we're looking at products. Gasoline had a build of 96, naphtha 74, gas oil 17, fuel oil 2. So when you look at where this is, even though we finished this week, gas oil is above where we were last week due to, again, seasonality. It's setting a new seasonally adjusted all-time low. We think that gas oil, again, drifts up a bit, but nothing crazy. It'll still probably set a new record for all-time low before the comps get easier and it falls within the base of that, within the kind of the middle range of that cloud. But I don't see us getting anywhere near to that 15-year, I should say 14-year average. Now, gasoline, on the other hand, is elevated. We finished out the year strong, and then we're starting out at a higher level above that average. We think they're going to try to manage the levels here, but demand, coming down a bit, that's going to put a bit of a headwind on how quickly they can draw it down, and the export market is a bit tough, which again is going to result in, we think, elevated storage. But as refiners try to adjust, target the gas oil side, they're going to try to reduce that gasoline level and then manage some of that flow through the export into the global export market. Fuel oil remaining elevated. Things have been even though the ARB should have opened, it still is remaining fairly tight right now. And that's keeping, again, more product in storage. And that's, based on what we're seeing right now, you could see this have a very steady move back to those seasonally adjusted highs. Now, when we look at Singapore had that large build that we were predicting. It went from 39 million to 42.3. So we had a build of about 2.3 million barrels. It was every level saw a build, but really driven by light and resid. So when you look at it on the normal level, as we were saying, we expect to stay above that 16-year average and still remain fairly elevated as we go through really the remainder of January into February, just because of that slowdown on the light side and then on the resid. So when we look at light distillate, you can see that we've had a fairly sizable move off of seasonal norms. And that's where we think it'll just stay elevated. Demand for gasoline west of Suez just isn't there. East of Suez starting to fall again, and that's going to put more in floating storage. Now, on the middle distillate side, even though we had a build, this is the one that remains in a very bullish backdrop. The demand remains strong in terms of where we are in heating, where we are in terms of just supply chain. So we do think that builds continue, but it's going to be at a very slow pace, and it's going to be at a fairly, it'll start to work its way up, but you're starting at a very bullish position. Where international, the resid side is not starting in a very good location, and we think that based on what we're seeing, this could it'll go sideways for a bit, but we do expect to see these builds accelerate and take out a seasonally adjusted high, because we do think that you're going to get a spike ahead of that seasonal spike that we normally get in February and March. So now when we shift to Fujairah, total oil products were reported at 15.3 million. Total stocks fell 1.2 million. And then when you look at, this is a reversal of last week's build when stocks were reported at about 16.5. So the total stock draw was by decreasing stocks of middle and heavy, while light distillate continued to rise, back to our point about Singapore. Light distillate rose 134,000 barrels to 4.885 million, which is a continuation of last week's build. East of Suez gasoline market opened the week on a cautious note. And just when you look at just general flows, you're continuing to see some of these overhangs. Middle distillate on the week came in at 1.246 million, a drop of 403,000. And this is a continuation of last week's, and it's the lowest level reported since December of 2017. When you look at the jet kerosene market, it reported tighter than expected spot supply and lower Chinese export quotas and curtailed regional production. Again, some of that production is going to start to come back, but you're going to see this stay tight for the next few weeks until we get some of that production coming back. Heavy resid on the other hand, when you look at it, it fell 945,000 barrels. Coming in at about 9.178 million. Demand for bunker, though, remains sluggish at the port. So that, again, is going to be a bit of the overhang. Offers for delivered marine fuel in Fujairah were heard at 645 to 670 a metric ton, which is on the lower end of the range, just not seeing a lot of that demand. But then on the more of the bullish side, Asian utility sectors were increasingly using high sulfur fuel oil cargoes from the Middle East to meet power gen demand during winter. And it's really because of the pricing, because that high sulfur. So as high sulfur increases, the shipping is going to be a bit of an overhang. But as that increases, you'll see some of that pulled through, and that will move some of that fuel oil from Europe out into the market. And again, this is some of that positive side, but it's going to be very much weather dependent to see how much of this can really continue. Then when we look at time spreads again got bullish again, moving to about a 71-cent spread between March and April, which again is supporting where we've seen some of these Brent moves. Now, when you look at crack spreads are coming, and refinery margins are coming under pressure as the crude price moves higher. That is just obviously going to put pressure on where those products are, especially as we've seen some of the demand slow down. So as margins compress, that will reduce some of the run rates as the margins continue to move lower. Same with Northwest. You're starting to see them, say with Ural starting to roll over a bit. Some of that will continue. And then when we look at what is happening in the Mediterranean, you're starting to see some of that sizable drop. And we think that that is going to remain the case, especially as we see more pressure on the differentials moving up. As differentials move up, that puts even more pressure on some of these refiners. Now, supertanker crude imports, you can see that they had a pretty big drop, and it's really because a lot of them have already shown up. The import quotas were slashed. That's again weighing on kind of where things are at this point in time, and then we expect that to remain fairly normal and around that 5-year average as we go through the remainder of Jan. Asian floating storage, taking out the 2021 highs. We think it stays in this location, and if anything really starts and remains elevated and drifts a bit higher, but you're going to see this stay at an elevated front. On the North Sea, you had a nice drop, and now we think that you're going to stay around the 5-year average, given where differentials are. Some more movements, so we expect this to be at about the 5-year average. West Africa had a nice drop from last week, but you can see that we're still seasonally at a seasonally adjusted high. And we see this continuing to move lower, but not back to the 5-year average, but now falling into the top of the cloud as we are seeing some of these movements from out of Nigeria and out of the Congo. Middle East, fairly stable, right around the 2018 levels. This is something that is going to be one to watch because, as we were saying before, if it kept drifting up, but they've cut OSPs, they're trying to move some of this and maintain some of this flow through. So we expect this to be fairly stable and really below where we were in 2020. But this is going to be kind of a key on how much lower can OSPs go in March. If this starts to build back up, we would expect to see some of those additional cuts in OSPs. Now on the European side, you can see that it was a nice drop. We expect this to bounce back a bit and come closer to the 5-year average, just based on what we're seeing in the floating market. So that's all we have for you today. If you have any questions, you can find me on Twitter. You can find me in the comments section. And as always, please like, share, subscribe, because your support is appreciated. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.